Good afternoon, everybody. Welcome back to this afternoon session, indeed the last session of our two-day event. To everyone who's joined us, thank you for staying with us so far. There's been some really interesting sessions, and this last one I'm sure will be no different. This panel will tackle the NPL situation in Western Europe and will be moderated by Sam Theodore, independent analyst and expert in this area. So Sam, it's a great pleasure to welcome you and the panelist, and I'll hand over to you now. Thank you.
Thank you very much, Martin. Thank you very much, everybody, for staying around. This is, as Martin said, the last session of the very interesting two-day conference. I benefited a lot from some of the presentations I listened to earlier. And basically, I think we are here a little bit as a conclusion to what everything else which has been said, because Western Europe is not a market which went through a massive asset quality crisis in recent years. Nothing similar to Southern Europe, nothing similar to what happened in other parts of the world. And yet, with the pandemic, with the crisis triggered by the pandemic, here we are discussing options for the future. So what I plan to do in this hour is, first of all, to thank a panel of distinguished panelists, and they'll be introducing themselves in a minute. And then I'll be going over some broad picture intro very, very briefly, which should kickstart the discussions, and then we'll get into the meat of the debate. First of all, having the views of the panelists on what's going on and what they expect to happen with banks' asset quality, with assets in a post-pandemic plan A and plan B scenario. And then a second range of questions would be focused hopefully on what solutions could be found, and clearly Paula, Jan and Dietmar will bring their own input and propose solutions and really discuss where things can be useful or less useful. So hopefully this will conclude the hour. If we have time for more topics, we'll go there. And one very important point, we welcome questions from the audience, and we'll try to answer questions if they're addressed to each specific panelist or to panelists in general. They'll be happy to do that. Before starting the introduction of the panelists, a brief intro on my part. So I have been covering the European banking industry for several decades now. I have spent 25 years in the rating industry. I was almost 20 years with Moody's, almost 15 years the head of European bank ratings at Moody's. And then I did similar jobs at smaller rating agencies, DBRS, and most recently Scope Ratings, which is a German-based agency. In parallel, I was also for several years a bank regulator. I was with the PRA, which at the time was called the FSA in London, right in the middle of the crisis, working on the asset management company, and other beautiful things happening in 2008 and 2009. And then I was a senior advisor at the EBA during the first 2 years of its existence, again focusing on stress tests, on the Euro sovereign crisis, which impacted, as we know, as we remember, the banking sector to a large extent. And I think that the experience that I learned is that the banking industry went through a massive crisis during the great financial crisis, the GFC. But what I see now is something different, and I'll be mentioning that in a minute. But before doing that, I would like each panelist to introduce themselves, perhaps starting with Paula, and then followed by Jan and Dietmar. So Paula.
Thank you, Sam. I'm Paula Lichtensztein. I work currently in the Structural Finance Division at Scope Ratings as a team leader. I joined Scope in 2017, and before that, I was part of the Structural Finance team at Moody's for about 11 years. I worked in a wide range variety of assets, including NPLs, consumer loans, SME ABS, and RMBS. I have an actuarial background. So before that, I had a career, before starting my career in structured finance, I worked as an actuarial consultant, focused mainly on life insurance and pension schemes.
Thank you. Jan?
Yeah, well, welcome. Yeah, good afternoon, everyone. Thanks for joining this conference. My name is Jan Petersen. I'm with Apleona Group, 20,000 people worldwide, mainly active in facility management, technical services, energy consulting, but as well real estate asset management and fund and portfolio management, which I'm heading. I'm managing director of the Apleona Invest. We are serving institutional investors mainly, on the one hand, the good side, so the performing side, helping them to set up investment funds, mainly currently investing in healthcare products, as we feel this is the right thing to do today. But on the other hand, being a banker from a profession for many decades, sounds a bit similar to Sam, but I was not in the banking authority active. I know exactly how to restructure things, and after the global financial crisis, I moved from the bank on the other side of the table to an investment house who had a huge portfolio in shipping, real estate, oiling platforms, drilling platforms who were distressed. And it's very good if whenever it comes to a crisis that you speak the language of the banks, because then you can negotiate much better. So we're doing as well claim servicing for asset-backed claims, but as well non-asset-backed claims. So happy to join, happy to answer your question. And my main topic is that I think we are not in the post-COVID phase. We are still in COVID, and it's going to take at least 2 years before we see the real impact on what's going to happen. Thanks very much.
Thank you, Jan, and thank you, Sam, for the introduction. And also I would like to thank everyone on the screen watching us for joining the session. We know it's the last session. Luckily, possibly you don't need to run for a plane and you stay until the end, which is good. To myself, my name is Dietmar Schulz. I'm a partner with DLA Piper. DLA Piper is one of the top 3 biggest law firms across the globe, international footprint. I'm co-chairing the global restructuring group. And as part of our group, we have a group which we call Banking Resolution. And that includes NPL work, but also other works, which is an option to tackle credit exposure. My personal experience with NPL goes back to possibly nearly 20 years now. I've been through the whole life cycle of NPLs, sell side, buy side, in particular in the early wave, which was in Germany about 15 years ago. And also I'm experienced a lot in multi-jurisdictional portfolio sales and cross-border restructurings, financial restructurings, and dealing with exposure. So all of that clearly is very helpful, and all of that clearly will be used when we discuss and consider what's coming and what are the options to tackle what's coming. Thank you.
Thanks, Dietmar. So thanks, everybody. I think it's interesting to see that there's a range of opinions. Hopefully we'll try to address them during this remaining 50 minutes. So why are we here? We're here because we have this pandemic crisis, and I totally agree with Dietmar. It's not over yet, but I would even call the post-pandemic crisis as worrying. So the pandemic is gone, but the economic effects of the pandemic are still going to be with us for a few years. So basically, as a bank analyst, I make an essential difference between the banking system crisis during the GFC 14 years ago, 13 years ago, and the banking crisis today. So I would say that today we have an economic crisis triggered by the pandemic, which did not reflect itself into a new banking crisis. Why? And I can cite at least 5 elements. The first one is the banks have a much stronger prudential and financial condition now than they had it in 2007, 2008 in terms of capital, liquidity, funding, and asset quality as well. Because you had those huge asset bubbles, not only the US subprime, but other massive asset bubbles existing at the time, like the commercial real estate in Spain and in the UK and everywhere else, and so on and so forth. The second reason is that banks have now, on average, on balance, not each of them in particular, a better, more focused management strategy, more risk averse, and more focused on creating value at the bottom line and not really pushing ROEs in the double digit without any look at risk, which was the case during the decade before the GFC. A third reason would be that supervision itself is much more risk averse, focused on risk, and more proactive than it was in those hapless years before the GFC. Supervisors are better trained, and also they are on the background of a much stronger regulatory environment. I think that on balance, the European Banking Union so far has been a success. I think that the single supervisory mechanism so far is working much better than individual supervisors would have worked without cooperating among themselves in a different scenario. I think that the existence now for the first time of a resolution framework adds value to the bottom line in terms of systemic safety, and of course much enhanced rules on capital and liquidity. And again, I'm happy to mention that at the time I was also part of the teams which work on this capital enhancement, the rules of the EBA. Last but not least at all is the fact that as unlike the GFC situation, when the pandemic started, public authorities were very quick to provide unprecedented massive support in terms of funding from the central bank, in terms of loans and guarantees and moratoria from governments. And I don't expect these measures of support to disappear overnight. It's going to be a tapering and a gradual disappearance, but it's going to take time so that economies can readjust to the post-pandemic environment. Having said that, this is obviously the view of a forest from far away. But if you really want to analyze the forest, you get closer. And as you get closer, you see that there may be a lot of rotten trees. So I think that this broad picture, which I think is more optimistic than many in the market assume, should not mask the fact that there will be individual cases of banks. I believe perhaps not among the largest banks, but second-tier banks, specialized lenders, which are going to experience massive asset quality problems. And you could say, well, that's going to be a case-by-case situation. Why should we worry about one specific bank? Well, because as we know, as we have seen in the recent past, once a bank in the system has a problem, the market, this opinion about the industry is interlinked, so the market would react negatively to the entire sector, repricing entire sector's debt and equity. So that's something obviously that nobody wishes to happen. So that's why we need to remain focused on all specific banks, not only to look at the big picture. And that's why we have these panelists, distinguished panelists today, and hopefully we'll get into the details. So in this case, perhaps we can start with Dietmar and then go to Jan and then to Paula. How do you see the situation going forward? Dietmar, you mentioned that the crisis is still with us, it's still going to be with us for at least 2 years. How do you see the situation evolving in Western Europe? Do you see it getting to a point where we saw, perhaps Southern Europe several years ago, or in a different light?
Thank you, Sam. And let me start by very briefly responding my view, my experience to the 4 pillars you're saying, why the banks are possibly much stronger than compared to the financial crisis about 10 years ago, which basically I do agree, but as you said, the moment we get closer to the forest, the more interesting the picture will become. So you mentioned the banks will be stronger because they have spent more care basically in doing their investments and with the lending. I think that's a fair conclusion, and that possibly applies to all of them, and that's clearly a result which comes by stronger regulation and capital requirements as a result of the GFC. So that's I think we can tick that box. We're all in agreement on that, I guess, or at least you and me are in agreement on that. Cannot speak for Paula and Jan. So then the better management strategy, creating value, that possibly goes along with it. We have seen some types of returns of covenant light loan documentations recently-ish, I would say, but that's not in that amounts and scales we have seen it previously. So that's clear. So that's also good. Supervision, we mentioned they clearly have learned the lesson, and then they are much closer, and they have created some responses, whether it's kind of by resolution authorities or asset quality reviews or whatever. So that's basically all good. And then of course we also have seen that massive governmental support schemes have been implemented across Europe to tackle, in particular, COVID-19 struggling businesses, which is also good. So in principle, I would agree to your general thesis. Then again, looking closer to it, what do we expect? We do expect, though, that now the governmental support schemes, they will be under review and under consideration. One reason clearly is that governmental support scheme is not there forever, and it's also a question to what extent the European Commission will allow further governmental support schemes. And at the same time, because it's taxpayers' money, we hear the first voices saying, please be more careful with spending rather than pouring money across everything. Please be careful what to do. And then it's obvious that now with the second wave of state funding is coming around the corner, industries where generally expected changes may happen, such as travel industry, touristic hospitality, and also things where I guess over the last year people have learned maybe there are other ways in doing so. I think there are requests to giving governmental support schemes more carefully than they did it in the past. For example, I mean, the airline industry clearly will be affected by that. The hospitality sector will be affected by that, possibly at a less scale. And then at the same time, of course, we will also see tourism in general might change, even say after this COVID pause, people are very keen in doing things. And then also we see a lot of small business, retail businesses, smaller agents, and I guess this Germany specific thing is because we don't have many chains, in no restaurant chains, no big hospitality chains in general. So so that leads to a lot of dying in the economy on small scale businesses, but this adds up to huge exposure. And to be fair, and this is right to the topic of our session here. So what does it mean on the other hand? So what does it mean for the lending banks? They need to tackle this, and that possibly comes up now, and eventually also in the next 12-24 months, because still there is governmental support scheme available, there are furlough schemes available, but that all comes to an end. And that across, I think that applies across Europe, and that means there's a lot of small businesses which totals up to a huge amount, and somehow this needs to be tackled, and this is nothing which will recover quickly. And then again, comparing it with what happened, what has been the response to the GFC, because a lot of that is unsecured, so there is not much you can do in terms of trying to find someone who has an interest into the asset or may turn around the asset, the underlying asset, because it's simply unsecured. So we will see different sort of players dealing with that. And then of course the question is again, how much appetite is there within the bank to offload this at all. Maybe they just write it off, or they try to help otherwise their customers. So that really remains to be seen. And then I guess to wrap up my point, I think we have different assets at risk, as we have seen in the previous crisis. It's a lot of, I would say, consumer loans to the smaller businesses. And then on the upper end, what we see, these businesses, they have received governmental support schemes in the first place that are big businesses. But again, I think this also will come under review. So clearly also this is something to be dealt with. But unlike, as I said, possibly compared to the global financial crisis, where it was pretty much the medium and bigger size, so the Mittelstand, that has been affected, it's likely that this is not happen in the same, I would say, distressed effect as we have seen it before.
Thank you. Jan, I think from previous discussions, I don't think you hold totally dissimilar views. Would you like to chip in now?
Yeah, sure. More than welcome. I would like to address 2 points. The first one is your forest, and the second one, I would like to try to compare the GFC, the financial crisis in 2008, 2009 with today. Maybe that might be of help. So coming to your forest, well, the forest is light green, and now in summer becomes darker green, and you don't see the rotten trees in the back. And this is actually the situation we're having today, because look at the capital markets, look at the stock exchange. Yeah, it's going up, 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 up. In Germany, in the US, and so on. Okay, it's smaller dips, yes, but there is big fantasy that things are improving. Secondly, the banks are liquid, so they have enough liquidity. Risk provisions are rather low. But the thing is that if you look in the forest to the smaller trees, like Dietmar said, the small and medium enterprises, we don't have them really on the radar. And that's what I said in the beginning, that I think it'll take 1 or 2 years time until we really see the impact. I hope I'm wrong, but I think it's gonna be bloody rather, because you have lots of medium-sized enterprises who have, for example, corporate bonds in the market. Will they fail? I think some will definitely fail. And so therefore, today the bigger picture is we have a vaccine, the stock exchange is going good, there's real estate prices are going up, but I think that there will be some developments which then will show, as I said, the real impact. Coming to the global financial crisis, that was mainly a subprime crisis with regards to mortgage lending in the US. And the prices here are going up in Germany, for example, as well in other European countries. The interests are so low, so people really can afford for small money a house, which normally with normal mortgage interest of 5-6%. You may remember we had this one someday in the past. What if they gonna lose now their job within the next 1 or 2 years because their companies go bankrupt? Yeah, filing for insolvencies are still so low. I think even lower than in 2019. So before COVID. So I think that it is a crisis which has a different pattern, like the subprime crisis once had. So we will see insolvencies of corporates. We may see an increase in unemployment, and that may impact for the real estate market, but as well will lead to a huge amount, quantity-wise, of unsecured debts. And in addition, small enterprises, they are currently, that's what I experienced, supported by the entrepreneurs. They inject own money because they want to keep up the business up and running. Yeah. So there we have the effect that they hope that COVID will be over, that then things comes back to normal, despite the fact that they've lost a lot of private invested money. But the impact for the banks might not be as big due to the fact, I think, Dietmar, you've mentioned it as well. The state has subsidized lots of businesses, the music industry, culture, retailers, and so on. Yeah. And in addition, there were kind of bridge finances granted by a state-owned bank. But the normal bank of the corporate is not liable for that. So it's all taxpayers' money, kind of. If they can't pay this back, if they go into default, then it's taxpayers' money. So it might be that it's kind of split. 50% burden will be taken by the normal business banks, and 50% will be taken by the state-owned banks. But still, we have to wait to see the real impact, whether this will happen or, well, hopefully not. But with regards to non-performing loans, after the GFC, we saw mainly asset-backed loans. So like Dietmar said, you could work on the asset, you could try to sell it or to restructure it or whatever. So there was a kind of value behind it. If you now have COVID, the main part, my gut feeling, will be unsecured. So we may end up with thousands of, let's say, private loans, yeah, unsecured, and then maybe thousands of small enterprises who are bankrupt, and then you're talking about unsecured loans, and then you will have non-performing loan portfolios, which are rather UTP, unlikely to pay portfolios, which is totally different from what we saw at the after the GFC. Okay, thank you.
Thank you, Jan. Paula, it's your turn now. What's your outlook on NPLs and things like that? You're an expert in that.
Yes. Well, actually, I want to give kind of an overview of the asset quality of banks, because also in the great financial crisis, we've seen that the role of banks providing liquidity to the system was very, very important. So I agree that there has been a significant decline in economic activity since the outbreak of the pandemic. However, European banks are not facing an asset quality shock. And there's consensus that NPLs will increase across Europe once all public measures are lifted or end, but still within manageable levels. And the factors I would mention that explain the resilience of the bank's asset quality indicators and that differentiate the current situation to the great financial crisis are, well, first, as some mentioned before, the proactive public support that helped preventing a general economic collapse and a credit crunch as it happened in the great financial crisis. And actually, even in the context of a slowdown in economic activity and an uncertainty about economic outlooks, banks continue to lend throughout 2020 to households and to corporates. And this has been an important element in avoiding a general economic collapse. And also, I agree, there has been quite a lot of state guaranteed loan programs put in place since the first lockdowns that actually help corporate liquidity positions. For instance, these programs were significantly used in France, Spain, and Italy, not so much in Germany or the Netherlands. And the level of guarantee varies across countries. For instance, in France, banks retain risk between 10% and 30%. You may argue that it's not so much, but it still means that they have done their homework on keeping underwriting criteria. In the UK, the Bounce Bank loan scheme, the loans are 100% guaranteed by the government. And I agree that one interesting point is that government support measures have increased codependency between corporate and government. So the timing and the manner of the withdrawal of government support will be a key determinant of the stability of both the corporate sector and public finances. But overall, I believe it has been positive for the real economy that public sector has taken counter-cyclical measures as opposed to austerity measures. And we don't expect state aid to be withdrawn overnight. I would say that there has been also, for some sectors, accumulation of savings. So net positions of some borrowers have not deteriorated. The second factor I would mention are these the so-called regulatory forbearance measures, especially moratoriums, and they have had the effect of delaying the recognition of new problem loans. It's true that loans still under moratorium could become a source of problem loans, and even though so far the performance of loan exiting moratorium has been comforting, the borrowers are still benefiting from moratoriums are likely to be more fragile than those who exited the schemes earlier. Again, it's interesting to see that the usage of moratoria has been most extensive in France, Spain, and Italy. In the first two countries, most moratoriums already expired by the end of 2020. In Italy, they have been extended until December 2020, unless even though the conditions are not the same, so they are a bit more stringent. And I would say that, like, again, at a macro level, another relevant point is that GDP growth is forecasted to be sustained across Europe, both for 2021 and 2022. And this will certainly help containing further NPL formation. So although borrowers in certain sectors, such as accommodation, leisure, transportation, are more at risk as they have heavily suffered the pandemic effects, as economies restart growing, public aid could be concentrated in those sectors. So overall, the recovery may be uneven across countries and across economic sectors, and there could be unexpected setbacks. So public support will still probably be a key determinant to the near-term economic outlook. The last factor I would mention on banks' asset quality is that banks have proactively managed the stock of existing problem loans in anticipation of deterioration in asset quality. So we've seen in 2020 that banks across Europe have generally increased provisional levels. And also banks have followed active balance sheet strategies that contributed to the stability of the NPL ratios. These strategies of cleaning their balance sheet include both private sales of NPLs and public securitization. So to ramp up, despite the overall flat trends in NPL ratios across Europe, we expect a new wave of NPLs, mainly driven by the repeated lockdowns and the level of loans still under moratorium. The precise timing and magnitude of this new wave is probably dependent on how quickly economies are able to recover. And in the meantime, though, we expect that banks will continue to offload a legacy NPL portfolios, both through direct sales and securitization. Actually, even through 2020, private sales and securitization continue to take place. Maybe at a slower pace, but they continue to do that.
Thanks, Paula. Now, what I take from these very interesting interventions is, one, is that Dietmar is very concerned about specific categories of assets. I would even add something which is perhaps not directly related to the pandemic. Everybody talks a lot about ESG. Banks have to get more into an ESG strategy, which is great and which is long overdue. But they have to finance green assets and green companies, which is great. But what happens to the brown companies? Brown companies have tens of thousands, like think about coal companies, oil and gas companies. They have tens of thousands of employees. They have massive loans outstanding from banks. So once the banks will no longer have the incentive to finance those, what's going to happen with the asset quality of some of these brown companies? Or think about some businesses which are going to be disrupted by the digital advances, especially now with the pandemic, people relying more on digital than ever before. So all these aspects are really concerning. especially since, as we all know, Europe is much more intermediated by banks than, say, the US or North American market in general. Also, Jan mentioned something extremely crucial, the fact that we are now in the state of a Goldilocks economy with artificially low interest rates supported by central banks. What's going to happen when these rates will start going up? How are large categories of borrowers going to be able to provide debt repayment servicing? Not to mention states, that's a totally different discussion. Let's not even get there about sovereign debts at unprecedentedly high levels. And also, I think what Paula mentioned is quite essential, the fact that this public sector is not going to disappear overnight. And maybe as people like myself assessing banks, we have to realize that we cannot totally disconnect the banking industry from the public sector. Even if a bank is private with publicly listed shares, it's still an economic tool of government policies, whether it likes it or not, whether it admits it to investors or not. That's not going to go away, and if anything, after the pandemic, that's going to be enhanced. Some of us start talking about banks as glorified utilities, which is probably not far from the truth. But then again, that presents a new set of challenges. So if I can go into the next set of questions, very briefly to talk about, okay, this is the situation. What possible options and solutions can we see there? So I'll turn first to Dietmar and then maybe go to Jan and then to Paula. And with respect to what Paula, because I discussed with her before, I think she covered for a long time the NPL situation in Italy. So she will try to make a point about what can we learn from that situation, not to repeat what was said at an earlier session, but to focus on Western Europe. But before that, Dietmar, it's all yours.
Thank you, Sam, and also thanks, Paula and Jan, for your interesting views. And Jan, you're, I guess, more in my on my view, and Paula has a bit of different view, which is also very helpful. So just to going back right to the question, Sam, what are the options? I think clearly, and I think I totally agree with Paula, the financial institutions facing increasing credit exposure now, they will clearly continue to work with their legacy NPLs, even if, and I think that's also common sense, that the banks have done very well in coping with, say, post-global financial crisis NPLs by coming now at a NPL ratio which is kind of okay-ish. So, but of course there will be additional exposure in the future, which will in certain aspects be COVID related. So also this is clear and we can't really change it. And then the first question, of course, you would have thinking about options from a strategic view. Are my existing tools, is everything what I just learned in the past years to deal with legacy, and as Jan rightly pointed out, mainly asset-based, real estate-based difficulties. Is this of help here? And if the answer is yes, clearly they will continue and expand this. That's the option number one. I think also what everyone is concluding though is that it's only a small portion of the upcoming COVID exposure which will fall into that category. So there will be different asset classes. So we need to be more creative of what are the options. And then clearly, I think one of the options is that the lender would need to consider about joint venture strategies, teaming up with what they did in the first NPL cycle, teaming up with experts, being experts in debt collection of that specific assets. So that's clearly one option. And there's always, of course, the option of running a private sale or running a securitization, but this will be clearly more different, and this will request new players being willing to invest. Also, I do expect there might be even a consolidation effect within the financial sector. That means there might be forming more specialized giants, say for specific asset classes, consumer loans, unsecured loans, leasing. And then also there might be more specialized lender then with focus on corporate and even green or brown loans, as Sam mentioned. And then of course, clearly there might be a mix of everything, but the answer is clearly not limited to NPL sales. It will be a huge, a bigger amount of options, and the toolbox will be bigger and more creative. And I think all of that should be, and I think it will be supported by the regulator by, say, eventually extending periods where banks need to deal with distressed assets, eventually also giving them longer periods where before they need to back up capital, so relief in capital requirements. That's possibly one thing that is also possible. I mean, there's of course on the other hand one tool which is still kind of the elephant in the room. It's interest increasing, because that's what of course is also helping the banks ultimately. But I think the general view is still that an interest increase giving within kind of also upcoming amount of defaults at the consumer end is possibly not helpful. So I don't think that this is going to happen. Again, just to wrapping up options, think about joint venture structures for asset classes where it's not core business and eventually other people are better in doing it. Think about consolidation, eventually M&A, being more specialized in what you're doing, meaning also then of course getting greater expertise when you consider credit commitments for the future. And then of course there are the usual blueprints available for private sales, for securitization and things like that. And again, my plea to the regulator is that they should allow the market some breathing space, and eventually we will see this already towards the end of the year when the auditors will discuss with the banks and then of course somehow with the regulator the outcomes of the audit for 2020. Thank you.
Before going to Jan, I have a quick question for you, Dietmar. When you say consolidation, you have in mind domestic in market consolidation, like in Germany, for example, or cross-border as well?
Well, again, it will depend on the market and on the asset class. I think when we think about consolidation for real estate lending, we may even distinguish between commercial real estate or residential lending. So that could be on a domestic level, and that, for example, commercial could be well on a cross-border level. Similar with corporates, so could be both. Yeah.
Jan, what's your view on that? Agree, disagree, your own views?
Yeah, sure. Yeah, coming to your first question with regards to the green industry and the brown industry, I've got two examples, which is the easiest way to turn brown into green. Shell oil just changed the name and only Shell, so the oil is gone. Now they are green, you know. And the same applied to Danish oil company. It's called Dong, and they renamed as well. So easy going. No, but that's not the solution at all, for sure. And the European Union as well stated that due to, for example, new investment funds rulings, you need to apply to ESG rulings, otherwise you can't invest anymore. So people are forced now to prepare for sustainable investments, and the companies who need the money, they need to become sustainable. But what to do? I think lesson learned out of the past crisis, 2009 and 10 and 11, I was involved in the recovery of ship funds, container vessels, and you name it. And there, jointly with auditors, we made so-called going concern strategies. In Germany, it's called IDV S7 concepts, where the auditors then confirm that the going concern strategy, including sponsoring by the bank, new credit facilities, blah, 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 are fine, and we have a future. Yes. With some ships, they did it 3 or 4 times, and then after 4 times, when the 4th time money was somehow injected, the shipping fund went bankrupt. So, and my point is that the government shouldn't widespread any subsidize any credit facilities. They should rather state, okay, folks, we've helped you out when there was the lockdown to pay your salaries to the employees, and so now we would like to have a clear investment funding for long-term investments to become sustainable, to invest in technology, whatever is needed for the company. And secondly, we grant you a budget that you can pay the auditors, who then set up a concept with you, a strategy, and they have to confirm, yes, there is a future in terms of future strategy, yeah, and future survival, or no. And if, for example, one industry has no future, the state shouldn't inject money in it because it's a dead horse. You cannot ride it. Know what I mean? So it should be in a professional, very professional approach, that you have certain milestones and certain kind of covenants, yeah, which have to be fulfilled, that this or that company will get the investment credit facility, will get the sponsoring for the auditor for consulting. I think then you inject the money in the right business. And you know, I was heading a supervisory board of an IT company in Denmark, and Scandinavia is just in advance with regards to technology. And they told me then, hey Jan, now you know what? Not Germany or the companies have driven the digitalization. COVID drove your digitalization, and it's true. I mean, can you imagine that a year ago almost everyone knows how Zoom works and uses MS Teams? No. So those are this is the future, I think. And just take, for example, the car industry. Should you invest in a car manufacturer who only develops cars with fossil, how do you call it, with petrol or whatever, yeah, or diesel? Or shouldn't you force him just to swap to whatever, to electro? So, and this is the thing, that if you subsidize companies, the state has to ensure that the money is allocated to the right companies and the right industry. That's my point.
Thank you. Paula, as you mentioned earlier, maybe you can very briefly make the point, because I think your point was that maybe the Italian NPL route would be a good route if real crisis develops in Western Europe, like in France, for example. So what do you think?
Yes, exactly. Maybe before that, Dietmar, you mentioned something quite interesting about joint ventures. And actually, this is already a reality in the sense that it varies across countries, and I will provide a few examples, but already special services, they are very active in the market, very professional, and with deep knowledge on how to service NPLs. And also regarding UTPs, which are clearly more challenging to service because they can go reperforming or to foreclosure. There has been a lot of development and also joint ventures, for instance, in Italy, between special services and banks. So there are a lot of options for sure. Going to public securitization, I think that it has several positive features. It helps creating more transparent markets. It favors data harmonization, something that regulators have lately focused on quite substantially. And one important thing is decreases price gaps, because one of the barriers that in some countries NPL markets have had was actually that the an uneven knowledge of what is in the portfolio that is going to be securitized or sold by the sellers, namely the banks and investors. It's also an efficient instrument for long-term funding compared to private deals, in which financing is usually short to mid-term. And finally, it widens investor base. So it helps diversifying market risk as opposed to, for instance, setting up a public sector bad bank. As very well known, the most active NPL securitization market in Europe are Italy, followed by Greece. And this is due to a combination of high level of NPL stock legacy from the great financial crisis, but also, and I would really stress that, the success of government-supported NPL securitization schemes. So if we take the Italian case, the percentage of impaired loans was around 4% at the end of 2020, which is still higher than 2.6%, which is the European Union average, but much lower than the peak of 17% in 2015. And the improvement of Italian banks' asset quality reflects NPL sales and securitization via the GACS scheme. The program was introduced in 2016, and it helped banks to offload around 80 billion of non-performing loans from the balance sheet, actually a bit more. Yesterday, a jumbo transaction closed of 1.5 billion. And there was an approval of 1-year extension of the GACS scheme. So we expect further activity in 2021, 2022. Well, most transactions have been done with the GACS guarantee. I will not go into details. Maybe if there's interest within the audience, I can go, I can provide some more details, but basically it is the senior tranche that is guaranteed by swap provided by the state. So my point is that most transactions have been done with the GACS guarantee, but there has also been some standalone transactions. And the high activity in the NPL market has surely helped also improving standardization of the structural features, the transparency of pricing NPLs, and it fostered secondary markets. So we have seen some secondary markets outside the GACS scheme as well lately. A word in performance, transactions have performed, I would say, mixed, with around 60% of the transactions performing below the original services expectations. And clearly this underperformance is mainly related to the effects of the pandemic. On the one hand, the lockdowns translated in delays in judicial proceedings, and also the slowdown in economic activity resulted in deterioration of debtors' affordability and liquidity conditions. I would say that it's yet to be seen if other jurisdictions will follow and adopt government guarantee schemes as a tool for deleveraging bad loans. But I would say that the Italian case is a very good example of a successful, let's say, solution for offloading NPLs from banks, which ultimately results in banks being able to continue lending and injecting liquidity to the market, and so fostering the economic activity. So far, other markets where we have seen sporadic securitization activity are Spain, Portugal, and Ireland. But in these countries, and also in the UK and Germany, we see mainly direct sales. The last point I wanted to make is about France, which is a quite an interesting case because the NPL ratio of the banking system is low, around 2.6% for the largest bank. But in terms of NPL stock volume, they now have the highest amount in Europe, around almost 120 billion as of December 2020. And why is that? This is because, and this is the case also in Germany, they have so far focused more on doing internal recovery activity because they can get higher recoveries compared to portfolio sales. And so their sales have been below European average. It should be said that they have huge loan books. So, and this is why they can sustain such high level of NPLs in amount. And but even though we have seen some trades, mainly in the recent years to services and investors with established operations in France, as opposed to international private equity buyers, as in other European countries, such as Spain or Italy. But now that the wind seems to be changing, so we might see a bit more of some direct sales. And this is it. Maybe a last thing, a word on special services. I think they are quite important for the market because they have specialized knowledge. They even specialize in secured versus unsecured sometimes. And so the usage of these type of institutions is quite effective, could be quite effective to as a solution to service NPLs.
Thank you very much, Paula. I think it's very interesting. In general, what I take from this hour spent together is fascinating. It's, you know, there's not only one line of analysis, one line of assessment. The situation is broad. The situation needs to be reassessed. Last year, we thought, you know, the pandemic is over, everything is going to go back to normal. Now we see a larger percentage of population being fully vaccinated, the pandemic perhaps being over. And before people start talking about the third wave, the concerns about the economy and about the financial situation of households and businesses is growing. So as Dietmar rightly said at the beginning, the pandemic is not over from the economic and financial angle. And I think these are very wise parting words here. I would like to thank everybody for having attended, and to the audience, those people brave enough to stay till the bitter end of this two-day conference, and very much, and especially to the hosts, to Martin and his colleagues for inviting us, and hopefully we'll be able to attend future events as well.
Absolutely. Thank you, Sam. And thank you to Paula, Dietmar and Jan for joining us today. It was a very interesting discussion indeed. And we hope to welcome you to join us again in the future. So thank you again for your time, and good afternoon.